Okay, folks, we are live and welcome to Sunday Night Futures Live. I hope everybody had an awesome weekend. And for those folks out in California, I got to be honest with you, I wasn't paying a lot of attention to the fires that were going on out there until this weekend. And my prayers go out to you. I really, really feel bad, and God bless everybody out there. It's terrible, absolutely terrible. Obviously, government has failed yet again. But before we start pointing fingers of blame, as we should, let's just get some prayers out there. God bless. Hope everybody makes it through okay, especially our firefighters. Talon, if you're out there, I sent you a message earlier today, hoping you're okay. And let's get to it. We only have a few people on. Let's get some. It takes some time sometimes to get people to flow in. Let's say hello, Jody. Hello to you. Corey, welcome. So I did a lot of time, spent a lot of time cooking today, and I carved out. I made a great shrimp fra diavolo. Awesome. Do you have any friends or family near the LA fires? The closest one I have is one of our members, Talon, who's a firefighter. Other than that, no, thank God I don't. I don't know many people on the West Coast. Most of them left. Hey, Sam, welcome. George, welcome. Okay, let's get to the futures action. And we have the, obviously the futures are open. S&Ps, they are struggling right now. They have opened down 0.12%. This is only a 5-minute chart. It's going to look more volatile than what it is. There is some active trade going on here. They're trying to hold the line. Let's just create an alert here so that way we're not staring at this at or above. I want to know if we put in new higher highs. And do we take out prior lows? I wish I could say I'm surprised by this price action. Unfortunately, I am not. Let's take a look at the NQ. This is the NASDAQ 100, the futures version of the QQQ. Initially, they tried to take this up. There was a rejection. Again, they're trying to hold the line here, but clearly some selling pressure moving into the new trading week. Let's take a look at the Dow Jones Industrial Average. Dow Jones is actually up fractionally. Just create some alerts here. Hey, Tim, welcome. Yeah, I haven't heard from him. Oh, actually, no, I did. I did hear from him in the forum. I think it was yesterday. I just responded to him today. So I think he's okay. TZ Burton. Hey, brother. Mr. Pete, welcome. All right, let's take a look at the RTY. This is the Russell 2000. Wow, really getting hammered. So the price action today, without having looked at yields yet, tells me that bond yields are probably moving up higher. Let's go to the mid caps, and then we'll take a look at bond yields. So ES just broke down to new session lower lows. The Mid caps are down 0.21%. Let's take a look at yields. Yields are actually down. Now, this time last week, you remember that we were skyrocketing on yields. So it's good to see that we're not skyrocketing up higher. And yes, in fact, relative to the close on Friday of last week, we are down, but relative to the after hours price action over the weekend on Friday, we are up relative to the after hours price action. Now, in terms of what volatility is doing, volatility is up over 0.75%. NASDAQ now down 0.25%, 10-year still down. Denny, welcome. Polish Taco, welcome. Okay, let's take a look at the currency markets. Patrick, welcome. US dollar. We have the Dow Jones, new session lower lows. Dollar is moving up higher. Let's go to a weekly chart, see how it closed last week. Very, very strong. And when you take a look at the euro is a basket case. The yen is a basket case. It's the least dirty shirt in the room. So the dollar moving up higher yet again this week. No new weekly higher high yet, but we'll be watching. Let's take a look at, yeah, Patrick, I have AAL on the list. I saw it. We're good. What was I going to bring? Oh, gold. Gold up fractionally. Silver down fractionally. Live cattle very close to new all-time highs. Inflation, corn, of which we are positioned, that is up. I'm trying to roll puts up. I don't know if it's going to happen. Soybeans up. We are long of soybeans vis-a-vis a put spread. What else? What else do we want to talk about here? Wheat. I may be selling wheat this week, meaning selling premium on wheat. I think that we're probably bottoming out. You know what? Pause on that. Not that excited. Forget about it. I retract that statement. What else do we want to talk about here? We have a lot to go over. Natty gas. Oh boy, ripping. We're long of natural gas. That is up 6.74% again. Amazing rally here on natural gas. And folks, you know, I talk about this all the time. I keep repeating myself that, you know, going into the new year, we changed up strategies. And that was we were not looking for momentum plays anymore because yields are moving up too high. The success of the transports to hold the breakout failed. Small caps, that rally failed. Mid caps failed. I'll go to a chart in a moment showing the percentage of the gains by the S&P 500 that are held by just 7 stocks. So you did not have a broad-based rally, and the market was telling you, you know what? Diversification within the equity markets is not an option. You need to start looking outside of the equity markets for diversification, vis-a-vis natural gas. We're long of natural gas. We're making money there. Soybeans, that's up, market down. It's uncorrelated assets. So, if your financial advisor is out there and he's telling you, oh, that's too risky, then you need a new financial advisor. If you were long, I went over this yesterday on best stock charts for the new trading week. If you were long last week of the banks, of the semiconductor space, of consumer discretionaries, that's a pretty diversified portfolio. They were all down at least 3% on the week. That's not a way to make money. So the way to make money is to go outside your comfort zone. Forget about semiconductor stocks right now. Forget about small caps. Forget about mid caps. Their time will come again, but the time is not now. Right now, we are in an inflationary period. We have a Federal Reserve that is not doing their job. All they're doing is claiming victory for the last problem. Now they need to orchestrate a new problem so they can come in and salvage it. The problem is that any problem they come in and salvage, they help create. So what's the next move on their part? They're going to have to fix a problem that they've already created. And my argument is going to be they should never have cut rates by 100 basis points. Never. That's Arthur Burns type stuff. That was the Fed chairman back in the early 1970s who fought inflation, got it under control. What did he do? Cut rates. What did inflation do? Came right back. That is what Jay Powell did. So now he's going to pay. We're all going to pay the price. He'll be just fine. I digress. So we have natural gas moving up higher. These names were hated a few weeks ago. Oil. What's oil? I forgot oil. Light sweet crude. How did I forget that? CL. Look at this. Oil skyrocketing up 1.5% at the open here. So there are bull markets out there. The question is, are you being advised of where they're at? Right now, the bull markets are developing in energy. They're taking off in natural gas, in light sweet crude, to a lesser extent, healthcare, gold, silver bouncing back last week and the past couple of weeks on the gold mining stocks. So there are bull markets out there, just not in the semiconductor space. Avoid those names. What else do we want to go over here? Did I cover everything? I think I did. Okay. I want to do a quick check back with the equity markets. NQ now down 0.23, 0.24%. It's broken support. It is now doing a check back. Not looking like a good open tomorrow morning, folks. ES. Trying to fight back. Okay. All right. So we're off to a weak start here. What pretty much the same. It's a replay of last week. What was working last week at current is working now. What was not working last week, continues to not work. But there are catalysts out there that could change the tune of the market, at least in the short term. So let's talk about what those are. So we're going to talk about short-term catalysts that may send the stock market up higher, but longer-term catalysts that could keep the pressure on the equity markets for a while longer. So let's get to it. Folks, if you're not part of our forum, it's free. Sign up, head on over. This is where you place your chart requests. Hey Pat, I don't know why you like AAL. I prefer Delta. Delta's killing it. They saved me a lot of money. I just booked a trip to London and Ireland in late April, early May. I finally locked it up, all the rooms today. They got me really good discounts, and I use the Amex Delta Amex card, and I got discounts with that as well. So they saved me a lot of money relative to using um, Kayak or Expedia. I think I only use Booking.com for a hotel stay in Kinsale. It was rough getting a room down there because they have a rugby team in town that week. Big rugby. I'm going to Kinsale for one of the biggest rugby events of the year. Apparently, I had no idea. But what do you think about a quantum bounce? It's so speculative. It's possible. I was watching what was that company? Not Rocket Labs. It got really hammered. What's the name of that company that got hit? It's the Italian name. RGT, RGLT, something like that. If somebody knows, if you could pop it in, we'll take a look at the chart and we'll answer Pat's question. All right. Okay. As long as you're making money. Okay. So enter your symbols here. ATOM for Mark. He loves that ATOM. Jody, I already have you. All right, let's get to it. Folks, this show is sponsored by not only the Contrarian Trader, but TrendSpider, of which we are a partner. If you're not currently using them, please consider them. Go into the new year with a Bloomberg terminal for the retail trader at your disposal. Automated technical analysis, automated trend lines. Some guys that are experienced say that I don't need those automated trend lines. I'm very, very experienced. I use the automated trend lines because A, it validates the accuracy of my trades or my support and resistance levels, and B, on the longer term time frames where you have stocks making multi-year all-time highs, sometimes you have no data points to feed off of. So the algorithm will pick those data points up and extrapolate off of prior peaks. So every once in a while, I am surprised, pleasantly surprised. So insane back testing and whatnot, strategies, AI now. I'm learning this. I mean, there's just so much. Take advantage of the discount code below, bare minimum 35% discount code. And they may be offering a better deal. Just use that code below on YouTube, link above on Twitter. And I just discovered this weekend while I was doing best stock charts for the new trading week. What's happening now? And people pay a lot of money. A lot of subscription companies out there are selling this. The Pelosi tracker. This is free. This is the same level membership that I give away to members. What else? What's the other one? This guy here. I picked off 3 trades yesterday. I'm looking to short NVIDIA, Apple, Lam Research, Sheldon Whitehouse. Senator's been dumping positions. And we're looking to short primarily NVIDIA because their earnings don't come out until February. Whereas with Apple, they come out pretty quick. Lam Research comes out pretty soon. I don't want to get wrapped up in those earnings dates. So NVIDIA is on our short list. On any rally, we'll be looking to short NVIDIA with a call spread. So again, sign up, take advantage of that discount code below. Let's talk about the economic data coming out this week. NFIB small business optimism. Notice how I skipped over the federal budget. Who cares? We don't have a budget. There's no budget. I didn't even think to talk about it. It's the monthly U.S. federal budget. It should matter, right? It doesn't matter. It should. But on Tuesday, this is when the real deal data comes out. We get NFIB small business optimism. Now, the real Pimp Mac Daddy of the week, there's going to be two of them. One is PPI, Producer Price Index. Watch it. Fed Beige Book. That's not the other Pimp Mac Daddy. The other Pimp Mac Daddy is the CPI, the Consumer Price Index. And then, of course, we get manufacturing surveys coming out. A whole bunch of Fed heads looking to guide the market to where they want to take them. Thursday, initial jobless claims. We get that each week. U.S. retail sales. A big data week here, folks. Big data week. Philly Fed manufacturing coming out. Business inventories, housing starts, building permits, forward-looking indicator, industrial production, a lot of economic data coming out this week, folks. And it's here. It's silly season. It is time to get ready to listen to the talking heads on CNBC, wow us with their pontification of how great earnings are. So, the earnings season begins with JP Morgan on Wednesday, Wells Fargo as well, BlackRock, Bank of New York Mellon, Goldman Sachs, Citigroup. And then we get a taste of tech on Thursday with Taiwan Semi, more banks, U.S. Bank Corp, M&T, United Healthcare comes out, Bank of America, Morgan Stanley, PNC comes out. Lots of banks coming out this week. We get a taste of the energy sector with Schlumberger coming out on Friday. More banks as well. And that will kick off earnings season. So for the next 3 weeks, it is going to be earnings. Buckle up. We have a market that is priced for perfection. We are at about a 37 handle on the Shiller PE ratio. Whether it be price to book, price to sales, whatever you want to price this market at, it is very expensive. Earnings had better be really good to sustain this market with a rising interest rate environment. The Buffett indicator. We remain, despite last week's slight pullback, strongly overvalued and ridiculously overvalued relative to historical trend and well above a 2 standard deviation move. It's not good. This is why we began to diversify away from equities weeks ago. Now, looking at the probability of a rate ease for January, it's down 2.7%, down to 2.7%. So January, forget about it. There's not going to be a rate cut. Unless something so disastrous happens between now and then, there's not going to be a rate cut. Going out to March, they're not pricing in a rate cut. 24% probability of a cut. May, these are all 100% probability of a cut only 3 weeks ago. As far as the eye could see, 100% probability, including January, of an ease. Now, ugats, nothing. Maybe in June, perhaps, slight. We're talking 6 months away, folks, from the next rate cut probability. So what's going to keep the equity markets up with these valuations? That's the question that needs to get answered. Now, last week, we had non-farm payrolls, which came out. And we're going to be doing a little bit of an analysis of what I believe is going to transpire after the inauguration. And I consider earnings season to be a binary event, meaning it could be a very volatile period. I consider post-inauguration to be a very volatile period. The why is that President Trump is a smart man. And being a smart man, were I in his shoes, I know that they're going to play me. They're going to throw barrels on fire down the mountain to prevent me from moving uphill with my agenda. That being said, what they must be able to do is they must be able to say, we handed Donald Trump a perfect economy, a mind-blowingly great jobs report. The final jobs report of the Biden administration it beat every single analyst expectation on Wall Street by far, by thousands. But what do we know about this administration? They lie. They lie. And they manipulate the data as if it's going out of style. So when we take a look at the data, we take a look at this is the U3 report. So unemployment rate 4.1. So how are you going to get the Federal Reserve to cut interest rates when you have an unemployment rate of 4.1% and you have a beat on non-farm payrolls? Not going to happen. Especially when you have commodities. We're going to go to the chart of commodities in a moment, ripping through the ceiling. That's inflationary. So the U3 report is a recently developed report back in the 1990s, because before that they used the U6 report. Now, the last read on this was a 7.8% read on unemployment. We still have, even with the spectacular jobs report that we got on Friday, a 7.5% unemployment rate, a real unemployment rate in this country. So what I suspect is going to happen, and I've repeated this to members ad nauseum. I probably have members sitting out there right now saying, I wish he would shut up about this. I can't, because I think that it's a major problem. It could be a good thing and it could be a bad thing. If Trump does the right thing, he's going to come out. He should be telling them right now, the Bureau of Labor and Statistics, weeks in advance or a couple of weeks in advance, you better get your revisions ready for week one. I want to know every single revision that you have to offer immediately, and throw water on any of these reports that have come out and that are false. And some people out there may be saying, you know what, I think you're being too hard on the Biden administration. He's an old man. He wants to do a good thing. Oh, really? So here is the last revision. We got this back in August. Many people forgot. I did not. It was a validation of what I suspected and what I still suspect. So back in August, to be specific, is there a date here? August the 21st, 2024. The BLS downward revision, the Bureau of Labor and Statistics announced a preliminary, folks, a preliminary, meaning subject to revision. Preliminary downward revision of 818,000 jobs for 2024. That's as of August, the first 8 months of the year. The BLS published the draft results of its annual benchmarking exercise, which stated the employment gains were previously overstated by 818,000 jobs. I'm sorry, I have to backtrack. It's through March, 3 months. 3 months out of the year. They overstated the jobs data by nearly 1 million jobs. That's not a mistake. That is nefarious behavior. Yes, government incompetence, sure. But this type of egregious miss is nefarious behavior. And I have little doubt that the hell that's going to open up of reality of what this economy really looks like after the election, buckle up. Now, what's the good side to it? The good side to it is that while equities may take it on the chin, you're going to get a decline in bond yields. Why? Because if the economy is perceived to be weakening, especially if jobless claims are revised markedly lower than what were reported, then you're going to see bonds rally and you're going to see yields decline because there'll be a worry about recession. Another way to measure whether or not the BLS is accurate in their reporting is all you need to do is take a look at the temporary work. Temporary help requirement is declining. This typically happens in economic downturns. In the gray here, these are recessions. And every time we roll over, we go into recession. We have been in a downtrend on temporary help for literally years now. Yet we're supposed to believe that last week we had gangbuster initial jobless claims. Excuse me, not initial jobless claims, non-farm payrolls. Another way to measure the accuracy, the honesty of the federal government is this. Take a look at the ADP employment report. This was also reported last week. Here on Wednesday, the expectation was for 136,000 jobs. In reality, what were created were 122,000 jobs. Yet the government's numbers, they blew away the best of Wall Street expectations. All for the sole purpose of being able to say, we handed Donald Trump the best economy ever. That's what they want to do. So here is the chart of the ADP employment report, the exact opposite of what the Bureau of Labor and Statistics has been reporting. It's in a downtrend where the Bureau of Labor and Statistics, their numbers are going up. Now, Thursday, we didn't do a live stream, and therefore, we didn't go over the Federal Reserve's balance sheet. And the balance sheet actually rose last week, fractionally. Very, very fractionally. Now, again, I've repeated this, but I will reiterate. There is no way on God's green earth that with the current debt service payments that we have, that Donald Trump is not going to come in and demand some sort of yield curve control on the longer duration debt. I don't think he can come out with a straight face and say, listen, you got to cut rates, not with the economic data looking as it is. If they revise it down, sure, then he can come out and say, listen, Biden screwed up the economy. He lied to everybody. You got to cut rates. That may work. But let's say I'm wrong. Let's say the revisions don't happen. Let's say these numbers are for real or less worse than what I'm expecting. What he's going to have the federal government do, the Federal Reserve do, is he's going to have them begin to buy up 10-year, 20-year, 30-year paper. That way, the bond market moves up, bond yields move lower, and it frees up the housing market, does a lot of good stuff. The however is, it's like throwing gasoline onto a fire of inflation. That's the problem. So for anybody coming in and thinking that Donald Trump is going to have it easy, he is not. He has a major problem, and that is Congress. He has got to cut government and cut it really, really quick. Tens of thousands of jobs and hundreds of agencies need to get cut, evaporated, wiped out. Or else everything stays as is. Now, in the news over the weekend, and I thought this was pretty fascinating. And if you're looking at trends in their early stage development, I think that this is one of them. JP Morgan Chase freezes employee comments amid return to office backlash. So I'm not going to read all this, but JP Morgan has informed that 300,000 employees, you got to come into office 5 days a week now. No more hybrid work. So JP Morgan happens to be a leader in business. So other companies are going to follow. So the question should be, what is the trade? Well, if we continue to see this trend, and I will be watching it very, very carefully, the trade is the obvious one. Regional banks. Now, don't get me wrong. I'm not running in tomorrow morning and buying the regional banks. This chart here is a cluster F. It looks like it wants to go lower, and they should go lower. The commercial real estate situation is a train wreck. And it's the regional banks, not the money center banks, that have the exposure. So if you get return to work and you get demand for office space, well then, values on those properties go up, and the owners of those properties are less apt to turn the keys over to the banks when they can't refinance. Maybe they can refinance now, especially if yields come down, values go up because occupancy is now going back up. Then perhaps the regional banks become a very attractive play. Not now. We need to see whether or not this trend continues, because the people over the past 4 odd years, honestly, hybrid work was taking hold well before COVID. Many companies were already doing it. It was just after COVID where companies really embraced it. So it's going to be a very difficult battle for these companies to right this ship. But on Wall Street, your talent goes down in the elevators every single day. And certainly in the financial markets, those people are going to need to come back to the office. And I always expected it. So regional banks are going to be a place to go and invest at some point in time in the future. We will be keeping track of the trend of return to work. Europe over the weekend. We know about the French government. It has collapsed. So France is what, the second or third largest economy in the EU. You have this monster of a person out there. Apparently, the EU was able to get the Romanian elections overturned. They voted in a right-wing party. The EU didn't like it. Therefore, they had the courts in Romania overrule the election, and they started all over again. They annulled it. Now they're threatening to do the same thing because it appears the right wing is going to take over in Germany, and they are going to try to annul that election. It's the end of democracy in the EU. So when we take a look at the euro, I mean, my God, the euro is just in absolute free fall. Now, it's great for me. I got a great deal traveling over to Europe. But man, if we take out 57 on the euro, I mean, I don't know where we go from there except for lower. I mean, that's going to be a train wreck. We are oversold, but the bear market in the euro is clear. It's defined. Sell any rally right now. As far as the equity markets, there's something called the skew index that has to do with the options market. Basically, when you're elevated, like we are right now, I have the overlay here of the S&P 500. It means that there's a lot of fear in the marketplace. And you saw it last week through the VIX. That did a reversal bar close very strong on a weekly and a daily time frame. The skew index, you see this red line here. Whenever we're above that, I know that we're in the throes of a bit of a panic out there in the markets. Doesn't mean we have to crash per se, but it means that there's a lot of pessimism out there. So be careful. We need a washout. Also, the yield curve, we're just off the highs of the new month and the new year. So this is a very, very dangerous place to be with the yield curve continuing to press up higher. Now, to be fair, in the past, when you had the stock market roll over, like in 2020, in 2000, 2007, you saw a slowing in the jobs market. Now, let's assume that the government numbers are accurate. Then that may not be the case. I'm trying to be optimistic here. I don't believe that the government numbers are honest. I think they're an absolute lie. And I think that I think the real problem for this economy is going to take place after the inauguration and after the next revision comes out for non-farm payrolls. I think that's going to be a major problem. In addition to initial jobless claims, the first week after the inauguration, we'll get a real picture for how they have been manipulating that number lower for quite a while now. So, yield curve flashing red warning flags. 10-year yield. I mean, this is a new multi-year high on the 10-year yield. We're at highs not seen since October of 20. I'm sorry. October of 2023. It looks as though we're getting ready to break out to new all-time high, not all-time highs, multi-year highs on the 10-year. And the problem for the market, I said 7 early, it's actually 5. 5 largest stocks in the S&P 500 account for 29% of the S&P 500, the highest concentration since the Nifty 50 during the 1960s. This was followed by one of the worst stock performances in history. So back then, in 1964, you had AT&T, General Motors, Exxon, IBM, and Texaco as the leaders. Now, Apple, NVIDIA, Microsoft, Amazon, Alphabet. NVIDIA fell apart last week. Microsoft we're short of. That fell apart last week. Broke the head and shoulders setup on a daily chart. Apple, I think I went over that one yesterday. That's weakening up. And Google, we're going to go over in a little while. So the concentration of market capitalization into the top 5 stocks, it's like sitting on a 3-legged stool. You take out that third leg and it's all over. So understand the structure of the market right now. On the week ahead commentary, which is I send out to members on each Saturday, where we talk about not just what the S&P 500 did or the Qs did. We take a look at the equal weighted basket. So basically, we take a look at the SPY. That's a market cap driven ETF. So that's influenced very, very heavily by these 5 names. And then we take a look at the equal weighted basket. And we've known the equal weighted was weakening for quite a while relative to the SPY. Same thing holds true for the QQQ, which is a market cap ETF with the same darn names driving it up higher. But then when you take a look at the equal weighted basket, that was divergent. So it was a no-brainer that at some point in time we're going to begin to fall apart. And here we are. And the specter of inflation continues to rise along with the government spending, folks. I mean, the trend is up. It's clear. It's defined. We did pull back for a short while, and we are well on our way back up higher. Now, I voted for Trump. I wish him all the best. I want him to succeed. I want this country to prosper, but I have a problem. I got a glimpse And that glimpse was during the debt debate when they wanted to uh, raise the debt ceiling only about 2 weeks ago. And when I heard that he wanted to uh, not only eliminate, or he wanted to eliminate the debt ceiling, but accept a 2-year pause on having this debt debate. So what does that tell you? It tells you that his plans are coming in and spending as he did his last term. He's going to spend a lot of money. And if you don't have offsets in the size of government, well, guess what? This only goes up higher. And I bet you if I overlay the CPI or PCE or PPI over this, those are the inflation benchmarks, they're going to be marching in lockstep because government spending drives inflation. It's the hidden tax. Chrome is freezing on me again. Come on, Chrome. It's like I have to reboot my computer 3 times a day now. Give me a break. Sorry, folks. So to put this into perspective, the government spending, what's happening? What's it resulting in? The CRB commodity index. If you're wondering why the 10-year yield is rising, it's because of this. We have a major breakout on commodities. We've taken out the highs of 2023. We are now nearing the highs of July of 2022. So the Federal Reserve, by cutting interest rates, did nothing but fuel more inflation. Here's the CRB commodity index. This is a ratio chart versus the S&P 500. Commodities are outperforming the S&P 500. Think about it. I started off this conversation this evening saying, you gotta step back away from the 60-40 plan of being in 60% stocks, 40% bonds. That's not working. Diversifying amongst equities, that's certainly not working. Maybe longer term it'll work. If you're young, stick with it. That'll be fine. If you're older, well, then you better start thinking a little bit more strategically. There are bull markets out there. They are in commodities primarily. Gold stocks recovering, silver stocks recovering, oil, natural gas is in fuego. And we're positioned in most of them. I think all of them. Yeah. Soybeans in that, corn in that. So we have positions in equities, but most of them are short positions. So I do have some long exposure. I have a semiconductor stock. That's not doing great. That's PI, Impinj. Newmark is another company that's not doing well, but they're small positions. We're diversified amongst the spectrum of asset classes out there. Here's soybeans. Perfect. Let's go to look. The market was down on Friday. How did we do? We did great. Soybeans were up. Here's a weekly chart. Getting ready for a big breakout. You don't short this. Yes, it's still in a downtrend. You don't short this. What we're doing is we're selling put spreads, deep out of the money put spreads, and we're getting ready to roll up that put spread because I think this is going up higher. Corn. Look at this move on Friday alone, up over 3% on the day. Now I need to roll up puts here because I have a call side that's being challenged. So this was supposed to be a neutral bet. Now it's becoming a bit of a problem child that I need to manage. But manage it we will. Here's natural gas. On the week last week, natural gas was up nearly 19%. We were long of it. And now it's up what? Another 6.62%. That's where the money's flowing. That's what we're looking for. Where is money flowing? It's also flowing back into gold. Gold on the month so far is up 2.8%. You have the S&P 500 down a percentage point. So gold is outperforming the S&P 500 by nearly 4%. Where do you want to be? Let's do some chart requests. And again, folks, this is brought to you by TrendSpider. I believe in this so much. I believe it's such a valuable tool. I give it away free to our silver and gold level members. So if you're ready to join the Contrarian Trader, use the link below. Silver and gold level members get this for free. If you're not ready, that's fine. At least take advantage of my discount code below on YouTube, above on Twitter. Bare minimum of 35% off of the product. And get to know, I love this. I didn't even know I had this. Get to know what the Congress is doing, what Pelosi is doing. This is awesome. And I like this as well. Where is it? Insider trades above 5 million. They filter it out for you. Zuckerberg's selling, still selling. But I want to go back to one other thing. And this is a really valuable tool. I wouldn't use it in this environment because the market's under pressure. But dividend yield, I saw it yesterday. Upcoming dividends here. These stocks here are eligible for what you call dividend capture. So what that means is that you could go to this chart here and say, okay, this company here, I don't know this company. What is it? PRMB, Primo Brands Corporation. Okay, whatever. Whenever their ex-dividend date is, it's the 13th of January. You can own that stock. You can go in buy it at the end of business on the 12th, if that's a business day, and then sell it on the 14th, and you capture the dividend. That's called dividend capture. I do that with Philip Morris from time to time. Well, excuse me, Altria. It's not Philip Morris anymore. So you have all these names here that you could do that with, and it's a great little strategy, but you really want a calm market. So a lot of good stuff here. Take advantage. Use the links. All right. We have a lot of chart requests to get to. I heard a couple of people add more in the end. Folks, if you didn't join up, this is free. You're not going to get charged for it. Head on over, use the link, and sign up for the Contrarian Trader Forum. Gary Meta, Sean SGOV, guys, try to limit these to 2, okay? Scott, I'll do don't touch LEBU. All right, just don't touch that. I'll do SQ and NTNX. I discussed LEBU on the week ahead commentary. So you may want to check that out. In short, I can give you the Reader's Digest version. Don't touch it. Hey, look who's here. Talent. All right, cool. We have 2 crews down south, so send prayers. Our prayers to your brothers. Great to hear from you. I heard they saved. Oh, great. Great news. Great news. Awesome. Shout out to our firefighters, heroes. All right, let's start it off with, we're going to take a look first, of course, as we normally do, from a weekly time frame. First up, ASML. There's nothing to do here. It's in a downtrend. I think I did this one yesterday. Yeah, I did this one yesterday. This is one of our best stock charts for the new trading week. It's a short. It did move higher on the week. Oh no, that was Lamb Research, not SAML. It. I think we're gonna fill a gap here. Would I short it? No. I'm gonna retract that statement. We had a breakout. We did a retest. We got follow through last week. They sold into strength. Now, yeah, a lot of support below. I would not short this. It's actually looking pretty good. It's come under pressure. I just don't want to buy tech right now. That's why I have a bias. I think if you form a wedge formation and then you get a breakout above, let's call it 770, and you close there, I think you can nibble, but you need to keep an eye on a couple of things. All right. You want to see yields going lower. If yields are going up, I wouldn't put the risk on because I think it's not going to end well. So yields need to be pulling back. Ideally, the dollar pulls back, and that will help drive ASML up higher. So I wouldn't short it. I would watch it, and I would watch for a breakout and a close above 770. Right now, all it's doing is forming a base. If you take a look at a monthly chart, yeah, man. To me, this is screaming avoid. To me, this looks like a bear flag setup on a monthly chart. I don't like it. I don't like it at all. I wouldn't short it, but I think that these volatile stocks are going to come under pressure. So right now, I would say avoid this stock. Avoid it. If the market changes its attitude, then we'll revisit it. But right now, I think there's way too much risk out there. This rise in interest rates must get resolved. It has to get resolved. If it does not, this market is in big trouble. Lilly, this is an interesting one. Monthly chart. We're up on the month. No new monthly high, no new monthly low. Weekly view. It's setting up for a breakout, but I wouldn't buy it until we break out. I think this is one where once we get past earnings, if you have a good implied volatility, you could sell a put spread, get long of it that way. I like it. It's firming up nicely. You have a bit of a Bollinger Band squeeze forming. Bollinger Bands in red inside the Keltner channels. We don't know which way it's going to get resolved. The fact that it's trading above its 20-period moving average is bullish. If it drops down below that 20-period moving average, it then turns bearish. So we're building a base, building a floor. I like it. I like the strategy of selling premium here, selling a put spread, 20 delta max. Schwab Dividend Equity ETF. Avoid. So a lot of people get caught up on the yield, right? But if you're going to, I don't know what the yield is here. Let's see what it is. SCHD. So you have a forward yield annualized of 10.85%. That's great. That sounds really, really great. The however is that if you're buying the fund into a downtrend, all you're doing is offsetting your capital losses on the net asset value is with the dividend. And if it trades down another $2.70, you're at break even. And then you got to pay taxes on the dividends. So I don't love it. I don't love it. I think that you need to wait for this to bottom out. Right now, it appears as though it wants to break down. If it breaks out, then I would become more bullish. But the problem for these funds is that, if you're in a rate cut environment, they do very, very well. Why? It's because treasuries don't yield anything. So funds, pension funds, hedge funds, portfolio managers, they need to go look for more risky assets to go put their money in to get yield. But if treasuries are yielding a 5% yield, then and it's risk-free, supposedly risk-free, then why do I want to get involved with an ETF? So that's in a decline, no less. So I like this. I don't like it now. You need to watch for things to bottom out. Wait for product demand. You don't have product demand right now. Nobody wants this. Once the Federal Reserve begins to buy back debt from the Treasury or cuts interest rates, then you want to buy this. Lock in that fat yield, because you're not going to be able to get that fat yield moving forward on Treasuries, and then you get the upside appreciation. One thing you could do here, dollar cost average. Stay small. Remember, you got to pay taxes on that money. So it's not net 10%. AAL? The airline's looking good here. The only worry I have about with the airlines is that fuel costs are going up. And if they're not adequately hedged, that fuel cost is going to impact them. But that being said, we broke out nicely last week. Money went into airlines, and it was reflected. Wow, this is looking really good. I don't remember the last time I owned an airline, but this is looking pretty attractive. You have a multi-year base, a 4-year base on AAL. Delta is already flying, intentional pun. So Delta looking good, AAL looking good. I think they're buys. I would probably go with AAL because it's breaking out of a downtrend channel. Bullish. Baidu. No, it wants to go lower. Right now on the month, I think I went over this chart a week ago, and we were bouncing at that support level in white. Now, at current, we are below that support level. Now, the month is not over yet. It's still early. We can rally back. And if we rally back and we close up on the month, then I change my tune entirely. Then I'll be an advocate for buying Baidu. But right now, at current, we are breaking down below monthly support, and it's not looking good. Weekly view, we broke support. I would avoid this right now. I would avoid. I wouldn't short it. It's too beaten up, and it runs the risk of reversing by the end of the month. AMD, there's nothing to like here. Outside reversal bar, bearish engulfing bar, whatever you want to call it, a ton of overhead supply, and these are I think these are my drawings. These are not the automated trend lines. Yeah, here's the automated trend lines. We broke down the week of December the 9th, and we haven't looked back. We're going lower on AMD. Jesus Christ. I'm going to get rid of all of these prior drawings here. Although they're pretty accurate drawings. You got to give me a little bit of credit here. I mean, I drew all these. Support here, rejection here. I'm going to do this. I'm sorry. I think we go lower. I think we're heading down to 10. What is this price here? 106.50. Avoid. Perhaps even short. BlackBerry. Wow. No wonder why this came up the list. We're breaking out. We've broken out. Monthly chart. At current, we sit above. What was that? We have a bounce back here on the NASDAQ. We don't want to be all doom and gloom here. If we have good news, we want to deliver that as well. Okay, so let's go to a 15-minute chart. I don't want to be on I'm not a day trader. This is actually looking optimistic right now for tomorrow's open. We're now positive on the session, so we have a potential here of a higher low. Let me illustrate. So we bottomed out on Friday. Now, what we want to see is a higher low. That's what we want. And if we break out and close above 2181 on the NQ, that's a higher high. Expect a rally. And the reason why I have a tone of optimism in my voice is because what's happening? Earnings. They're going to want to manipulate the market. I call earnings season silly season for a reason, because you get the talking heads with the slick back hair, and they come onto CNBC and they pontificate about why earnings are so great and how this quarter is so much greater than every other quarter that ever existed. It's silly season. It's all nonsense. It's all BS. So expect that, and expect a little bit of manipulation. That would be a good thing. Back to BlackBerry. We're breaking out on the month, but the month is a long way from being over. Let's take a look at a weekly view. We broke out last week above. This is an automated trend line. I did not draw this. Click of a button. We broke out and closed above. I would look for a retest of $3.84. If we pull back, give or take a penny. If we pull back to that price point, I'd be a buyer with a stop loss right below $3.59. That's the play. The Google. I think what took some of the steam out of Google was that they have that new chip that's out. Willow. I think it's called Willow. Fact check me on that. And that's a quantum chip. And I believe it was the NVIDIA CEO that came out and said that basically quantum chips or quantum computing is another 15 years out before there's any real use for it. So I think that is what took the air out of Alphabet last week. Now, it didn't break down below support. It did flash a bearish reversal bar. Would I buy it? No. Would I short it? No. I would watch it. As long as it holds 187.73, it's still alive. If it closes down below that mark, we're coming down here to 173.58. If we consolidate along this rising support level here, 195.50, give or take a dime, then I become constructive. If and when we break out above 201.71 and we close there, I become very, very bullish. Right now, the money's made on the buy. So right now you need to have the patience and just to sit there, watch and wait, because this could go in any direction. So patience, patience, patience. And don't forget, of course, they have earnings coming up. Tesla for Jody. Right, Jody? That's what you requested? I think she always requests Tesla. Yeah. Here's the monthly view of Tesla. It's still up on the month. The however is that it has broken a rising uptrend channel, and this could be a check back. And we've already begun to fade on Tesla. Let's bring up our stochastics, see what they're saying to us. Not bad. It's not bad. Weekly view. Very close to a bearish engulfing bar. If we break down below 375 and close there, avoid. Now, we shorted this off of this high here. We sold a call spread. We're out of it now. So I'm not a buyer. There's just no setup here that I like. There's one developing on the daily chart. Maybe. You have a very tight consolidation, a wedge formation forming. You want to see these Stokes hook up, momentum hook up, and you need volume on that breakout. So Tesla may be setting up for a breakout. But I would wait for the breakout. Don't anticipate the breakout. Hope is not a strategy in this market, okay? Wait for the breakout. And make sure that the momentum on here, the Qs, you don't want to see these Stokes, going like this. You don't want that because rallies tend to fade. What happened all last week? Rallies faded. Here. They tried to rally here a little bit. Here. I mean, there's money flowing out of the triple Qs. There's money flowing out of the S&P 500. Momentum is going the wrong direction to put on big bets. Here again. Okay? You don't want to see these lines. I know the squiggly lines and whatnot. I use them all the time. It's momentum. The market is sending a signal. Don't touch these names right now. Avoid. At some point in time, there's going to be a change, and they're going to hook up, and money flow is going to begin to move back in. So right now, Tesla, I would just watch it. And if it does break out, see if the market is following through as well. And then if you have the market trading along with Tesla, execute the trade. If you have Tesla up, market down, avoid. Any one stock's not going to outperform the market for very long. ATOM. So we got a pullback here. Wow. Outside reversal bar. No great shock. We kind of knew this was going to come, right? So it looks like you're probably going to have more downside here. You have institutional distribution last week or a bunch of day traders in and out of here. You have support at 1045 and 1011. Hey, listen, if you want to be speculative here, if they drop it down to around $10 a share, you want to try it, fine. to the upside. I would not stay long. Momentum is rolling over here. Volume is picking up to the downside. So any rally should be sold on ATOM. It had a great run. Meta. You're welcome, Jody. All right, let's get these lines off here. Clean this up. Now, Meta, it's holding up fairly well. You're still putting in. Let me get rid of all this. I have all these automated trend lines, yet I still draw lines all the time. It's a habit. I can't. It's an addiction. Okay. So Meta continues to put in higher lows and higher highs. Momentum hooking back up. Volume last week was good and it was up. Daily. Would I buy it? No. Can it be bought? Sure. I would prefer to buy it at this lower band of support back here. Therefore, I wouldn't buy it. So if you're going to do it, if you're looking for support level at which to be put in a stop, 596 looks like a reasonable support level to get out if we break it, because if we close down below that mark, we're coming down here to 580. So don't let a little loss turn into a big loss, please. SGOV. So this is a short-term bond fund. I can't use a daily chart here. It's very stable. Looking at this, it looks as though we're at the end of a trend. It looks like we go up 3-4 bars and then we pull back. We're on our third bar. At best, we're going to get a fourth bar and then we're going to pull back. I wouldn't buy this. If you're looking to buy it as a trade, I wouldn't buy it. And it doesn't move all that much, so I'm not quite sure of the trade here per se, unless you're just looking for yield. And what is this thing yielding right now? SGOV. 5.18%. On that basis, I would buy it. It's a good yield. Very good yield. So I really have no other opinion on this one. Technically, I think it's going to pull back. Honestly, that's the trend is pretty clear of how it works. Up 3-4 weeks, then down. Up 3-4 weeks, then down. You're nearing the end of that cycle. SQ, Square, or Block now. Broke support last week. Expect a check back. They're probably going to rally this back up to 85.91. I would fade that rally. I would get out. I think it's going to break lower. Momentum rolling over. Decent volume last week. There's no reason to buy this. Not at these levels. Daily view. Yeah, it's breaking down. Would I short it? No, because you're going to have support right at around 78, 79 bucks a share. There's not enough meat on the bone to short it. I don't want to take that risk. Last one up, NTNX. Any thoughts on the bank's unrealized losses? As long as there's a Federal Reserve, we had more banks that went out of business during the 2023 uh, autumn correction in the regional banks. And more banks than back in 2007, 2008, 2009 combined. Yet it was a blip on the screen. So I think the Federal Reserve, as long as they're around, they're going to paper it over, and that's it. I think the banks are going to be just fine as long as the Federal Reserve is there backstopping them. They're insolvent. They're insolvent. So as long as it's a Federal Reserve, I mean, it's socialism, communism. Agreed. Yeah, no doubt. Yes, please like, subscribe. You know the deal. Please, let's wrap it up with NTNX. Let's go to a weekly chart. We're already on a weekly chart. Now, technically, we broke out last week, if you could believe it. We broke out of a downtrend channel. Momentum on a weekly time frame is going in the wrong direction. Stokes trading down below 50. Rallies tend to fade. I'm going to get a T-shirt made up. Rallies tend to fade when these stochastics trade down below 50. And what happened last week? They broke it out and then they faded it. I wouldn't buy this stock until we get a few weeks of consolidation along this $60 per share line. Thank you, Pat. Yes, please, everybody, like, subscribe, please. Helps me out with the YouTube algorithm. So I wouldn't touch this right now. I let it bounce around. Let this get resolved. I do not initiate long positions when you have momentum going in the wrong direction. Again, rallies fade. Daily view. Here's the breakout. Here's the check back. The daily chart is firming up here nicely. So this $60.77 mark is very, very critical support at current. I don't think there's any rush. If you are in a rush, you want to scratch the itch, put on 10%, 20% of your position max. Use a stop loss order right down below the lows of January the 2nd. You close down below that mark, get out. If you begin to break out, the market begins to heal up and behave well, then add more on a new higher high above 64.71 per share. Folks, thank you for being here. You're very welcome. George, thank you all for being here. And again, to our firefighters and to everybody out in California, God bless. And I hope everybody has a profitable trading week and enjoy the remainder of your Sunday. Don't forget, TrendSpider, I give it away free to our silver and gold level members. If you're not ready yet, I understand. At least join the public forum. There's a link below and get TrendSpider. Minimum 35% discount code below. Take advantage of it. I'll talk to you soon. Have a great night. Be well.